Hello, and welcome to Virtual Investor Conferences. My name is John Viglotti on behalf of OTC Markets, as well as our co-host, Skyline Corporate Communications. We're very pleased you joined us for our next presentation from Flow Beverage. And before I introduce our speakers, a few points to note. Please submit your questions in the question box to the left of the slides. And if you're interested in scheduling a meeting with Flow Beverage, please click on the Meetings tab found on the left navigation bar. You'll be able to view the company's availability and submit a meeting request. On a final note, all of today's presentations will be recorded and available for 24/7 replay. At this point, I'm very pleased to welcome Nicholas Reichenbach. He's the founder and chief executive officer, and Trent McDonald is the chief financial officer of Flow Beverage Corp, which trades on the OTCQX Best Market under the symbol FLWBF and on the TSX under the symbol FLOW. Welcome back, Nicholas and Trent.
Thanks, John.
Thank you for having us.
Great to be back. And thank you, everyone, for joining us today. And thank you to the OTC for organizing this event. As John mentioned, my name is Nicholas Reichenbach, Flow's founder and CEO. And I'm joined today by Trent McDonald, Flow's chief financial officer. For our disclaimer-looking forward-looking statements, please refer to slide 2 of the presentation. I'll begin today's call with an overview of Flow, and then I'll turn to some of our very significant announcements we have made in the last 3 months and provide an outlook for future growth drivers. Then I'll turn it over to Trent for an overview of our financial results and a look at our plan to unlock shareholders' value. After the presentation, Trent will take your Q&A. In 2015, I saw a mountain of plastic bottled waters after leaving a festival called Burning Man and thought of an idea to solve the problem. That's how Flow was born. Since starting with a single family-owned artesian spring in Canada, Flow has grown rapidly. And our commitment to providing naturally occurring alkaline mineral water with a delicious natural taste without a plastic bottle has grown extremely well. As a certified B Corp company, Flow meets the highest social and environmental standards. From our 100% recyclable, 75% renewable packaging that minimizes the use of natural resources, Flow has consistently worked on providing a sustainable hydration solution and to protect our planet for generations to come. Our product portfolio includes our naturally occurring alkaline spring water. And for those in the US, our spring is in the Shenandoah Valley in Virginia, which is a similar size to our spring in Ontario that services all of Ontario and Canada, and the Virginia spring servicing all of the US. We also infuse our products with organic certified ingredients. We have a flavored product line that has my favorite, cucumber mint, which won best water on the planet 2 years in a row, along with a lot of 4 or 5 other infused flavored waters with 0 calories, organic certified. We also have a line of collagen infused water, and we've recently launched our vitamin infused line with functionality around immunity. And we'll continue to further grow our product portfolio against our consumer, which we have an estimated 18 million consumers, dominantly in the United States of America and Canada. And they're focused on health and wellness and buying natural organic products. We have one of the highest net promoter scores in any CPG company of 79, which means we have a lot of loyal customers purchasing Flow on a regular basis. Subsequently to our fiscal 2022 year end, which ended October 31st, we made a number of game-changing moves that significantly improved the company's financial trajectory. The common thread of all these initiatives is that we've been taking an aggressive action towards the goal of achieving profitable growth for the Flow brand. In November, we sold our Virginia production facility for $19.5 million US. We initiated internal restructuring in December 2022 and raised another $15 million of senior secured debt in January 2023. The debt facility also allows us to draw an additional $5 million in fiscal 2023. These strategic initiatives have together provided a cash injection of $31 million into the company, and we expect to realize cash savings of $17 million in fiscal 2023 without impacting the growth of Flow's brand. In fact, with over 26 million cash today, we believe these initiatives will provide the company with the financial flexibility to invest even further behind the sales and marketing to drive profitable growth for the Flow brand. Today, Flow is in over 46,000 locations across North America. This is an 88% increase over the previous year. With recent wins, including 11,000 Dollar General, 5,000 Family Dollar locations, and another 500 combined locations with Fred Meyer's, ShopRite, Market Basket, and BJ's. Turning to slide 6, you can see that we are the market share leader in carton format water in the United States. Our market share in this category has increased to 44% from 40% of last year. And this does not include the impact of our recent wins in food service or recent innovations like vitamin infused, which I'll discuss shortly. In Canada, we are the only carton format water, making us number 1 in North America. Flow has been sustainable since day 1, and the investments we make have made us best in class environmental standards, which has been critical to our growth. Our Flow water packaging is in Tetra Pak. These cartons are recyclable and made from 75% plant material. Furthermore, Flow's operations are carbon neutral, and we protect our water source through stewardships, land management, and draw minimal sustainable usage from our springs. In fiscal 2022, we made amazing progress in building on our leadership and sustainability through our NASDAQ 1 reports for investors. We've also maintained our B Corp certification status, and we remain one of the top ranking B Corp certifications in the world, along other brands like Patagonia and Seventh Generation. I'd like to turn to slide 8, where it highlights some of our milestones in 2022, which will help drive growth in fiscal 2023 and beyond. In addition to record store counts and gaining top market share, we launched vitamin infused water in Canada and the United States and are getting great feedback. We also signed a number of ingredients with leading food service brands in that food service sector, with household names like Norwegian Cruise Line and luxury hotel operator Accor. Our most recent distribution agreements in the food service have been with Foodbuy, which represents an additional 11,000 locations across North America, and Starbucks Canada, which has another 1,000 locations carrying Flow from coast to coast. Last year, we also signed a distribution deal agreement with Primo, who serves 1.8 million subscribers and customers across the United States. Primo Water, that is. We also expect to continue to grow and sign new distribution agreements in both retail and food service. Our beverages have functional benefits which many customers are seeking. We are aligned strong with those that want premium products, and most importantly, our consumers are drawing on their sustainable features. The last data indicates that sustainable beverage category has grown over 60% per year. Now I'll pass it over to Trent.
Thank you, Nicholas, and good afternoon, everyone. I would like to begin by reiterating that we are in the midst of an operational transformation that we believe will provide long-term financial sustainability for Flow and provide the company with a pathway to profitability. One of the many imperatives of this endeavor was to strengthen the balance sheet and dramatically improve our financial position. While this will continue to be an ongoing focus, we believe we've accomplished a great deal over this past several months. One of the themes of our Q4 and year-end results was one-time non-recurring items. We felt it was very important for us to de-risk our entire balance sheet at the year-end so we could set the organization up for a much cleaner and more profitable fiscal 2023. With that said, let's discuss our recent results. Flow brand net revenue increased 38% in fiscal Q4 2022 and 26% for the fiscal year. The primary driver across both these periods were the successes we've had in unlocking new retail stores across North America, while we continued to build momentum within our e-commerce channel. These growth rates, just so you know, are 3 times greater than the beverage industry growth rates. Looking forward to 2023, we expect continued growth in the Flow brand, while co-packing revenue will decrease based on capacity utilization. We believe that to maximize shareholder value, we should focus on developing the Flow brand. So that is where we are going to allocate resources, adding more retailers, expanding our food service franchise, and getting new product innovations like vitamin-infused water into stores across North America. Our normalized gross margins were 28% for Q4 and 25% for fiscal 2022 when considering the impacts of some of those non-recurring items I referred to earlier. Furthermore, normalized gross margin was impacted by the higher relative production volume coming out of the Virginia production facility, which we sold subsequent to year-end. Even though gross margins have been improving steadily, we still believe there is upside. With the sale of the Verona production facility, we now have fixed our per unit cost for all units of production coming out of the United States, and we have removed the cost of unutilized capacity. In addition, we've added volume to Aurora, which will make that facility's production even more profitable. Our EBITDA loss increased 10% in Q4 and improved 29% for the fiscal year. As it relates to Q4, we took a $2.8 million in non-cash charges, which of course impacted some of the improvement we had been making throughout the entirety of F22. Looking forward to fiscal 2023, we are working through several broad-based operational cost savings initiatives, which we believe will provide an even better pathway to improve margins in quarters to come. You can expect that we will continue to invest in sales and marketing to aggressively grow the Flow brand, and that general and administration costs, as well as salaries and benefits, will decrease in fiscal 2023, given the impact of the Verona sale, our internal restructuring, and other aggressive cost savings initiatives that we've identified. As we've recently acknowledged, our stock price has underperformed, and for several legitimate reasons. As management and in speaking for our board, it was critical for us to stabilize the organization by mitigating risk on the balance sheet, strengthening our financial position, and dramatically reducing our cash burn. We needed to ensure we had a clear pathway to profitability and the runway to get there. Only then could we possibly argue that Flow was undervalued. While we have been executing on that plan and at a hastened pace, we believe there's still a lot for us to accomplish, and we are very pleased to see that the markets are taking notice of our efforts. That said, on slide 11, you will see that Flow is still trading at only 0.9 times its revenue versus 2.9, the simple average for our peer group, and 5.1 times the weighted average of our peer group. Even though we have gone from 0.3 times to 0.9 times revenue in the past month, we still believe there is significant value to unlock. We are still at the beginning of a long road, which will entail proven execution, improve results, lower cash burn, and what we expect to be a very aggressive investor relation plan. With that, I will start taking your questions. Thank you very much. Okay, everybody, thank you for that. As you'll notice, I'm no longer in the same location. We did actually pre-record that, as Nicholas, we knew he would be out of town and unavailable for the question and answer period. So I am sitting here ready, willing, and able to answer your questions. And we do actually have quite a few coming in, so that's great. Let me start with the first question that I'll address, and I'll read it out for everyone so they know. What was the rationale for selling the Verona production facility? Well, I did actually just mention some of the rationale for that, but inevitably it was really truly around two primary things. One, we weren't running it efficiently, and we didn't think we had a pathway to get it to a point where we were running it efficiently so that it could become a true profit center for us. And because that was the case, and we didn't have those volumes going through, we weren't running it as efficiently as we could. We took the opportunity to monetize that facility at a point in time where it wasn't going to result in any kind of a capital loss, and we were able to get back out of it our net book value. And what that did was two things. It put some cash into our bank, for sure, to the tune of approximately $17 million, while also mitigating what would have been net $13 million of cash outflows that would have come as a result of continuing to operate. So if you think about the differential in cash, that means over years, 17 million in versus 13 million out, it's big. It also provided us with cost certainty on our margins as we locked into a co-pack agreement. We know what the cost of materials are, and we're only paying for what gets produced. And as a result of that, we know and can predict what our margins are going to be coming out of the United States and that production facility. And we think we can obviously get through higher volume. We can get even better costs, especially when you consider the allocation of logistics and distribution to each product that we are producing. So the more we continue to increase our sales, which we are doing aggressively, the lower our costs will inevitably be on the production side. So there's a lot of benefit from that transaction. Can you talk about margins through your various distribution channels at a higher level? Well, look, we water is heavy, and we are geographically dispersed in terms of our actual consumer base. So logistics distribution is something that we are clearly focused on right now. We are going through an entire organizational review that we've started long since, and we believe there's a lot of room there for us to shave costs and to increase our margins overall. Different distribution channels cost a little more, whether it's DSD or through distributors or direct to consumer like e-com. Each one is a little different than the next. Our e-com avenue, especially in highly populated areas like Greater Toronto, New York, to speak of a couple, is very accretive from a margin perspective. We do discounts and other things, and we do still have some trade spend there, but not as high as a percentage as it would be going into retail, as an example. So we do make good margins on e-com, and that is its area of our business that we're focused on, and it continues to grow. So hopefully that answered some of your questions. What are your growth drivers for 2023 to 2025? So what's our 3-year operational plan is what you're asking. Well, look, it's a great question. We've made no secret of the fact that we believe a large part of our strategy should be in food service. And what that does is it promotes trial of our products, of our brands, when we have a very a client or a consumer that is there and doesn't have a lot of choices in that situation around what kind of waters they're going to drink, because the food service organization that we're dealing with only has a certain level of choice providing to their ultimate consumer. So they have that trial. And so a great example of that is Norwegian Cruise Line, where you go onto a Norwegian Cruise Line off the East Coast of New York, and you're going to have flow water. Same with Accor hotels, like Fairmount. One of the biggest ones in the food service industry that we've recently announced was Starbucks here in Canada, where we have now gotten into pretty much all of their locations across the country, and have usurped one of our biggest competitors out of that spot with Starbucks, because look, Starbucks was looking for a very a sustainable company that with high growth, and we fit that bill as a B Corp organization and as one of the top 5% of ESG rated companies in the entire world. So it's a great thing for us to continue to grow. We're also trying to grow in retail, and there's no doubt about that, and e-com. So we're constantly opening up new doors and getting into new doors, both in the United States and Canada. I think we have a lot more growth opportunity in the United States because we are still in our infancy. And ideally, we would be doing multiples of our sales in the US versus Canada. But there's still a lot of room to grow in Canada as well, both in retail. So think club with Costco, and then other retailers going into conventional aisle versus just the health aisle. We have great partners in health with places like obviously Whole Foods has been a really great customer of ours. So there's a lot of avenues for growth, and we're being very aggressive. And you can see that in our last couple of quarters. We just announced 38% growth in Q4, which I think I just said it was 3 times the beverage industry. It's not the beverage industry. It's 3 times functional water, which is a very high growth area of beverage. And we outperformed that segment by 3 times. So we're doing very well, and we're going to continue to push the envelope on sales and marketing. I noticed during the Montreal Canadiens press conference that there are 2 cartoons of Flow Water front and center. Is there an agreement with them to promote Flow? Yes. Yes, that's the answer. We have been partners with the Montreal Canadiens for some time now. And that's another great food service organization where you go into the Bell Center in Montreal, and you're going to have Flow. And that's what they sell. And it's another great avenue for us to promote trial and have customers come out of there and go into other channels to buy our products, whether it's in retail, club, or e-commerce. And it's a great avenue for growth, and it's been working very well for us. Can you go into more detail about the company, about how the company is investing into the IR program? Well, look, that is something that we hadn't been doing a great job of. Clearly, when I came into the organization, there was a lot of conversation around that particular issue post IPO. But look, in order to be able to do a great job of IR investor relations and outreach, you have to first start with what story are you telling? And we didn't really have a great story. As I said, our price was under pressure. Share price was under pressure for a lot of legitimate reasons. Cash burn being one of the big ones, and people not realizing that we'd have or seeing that we even had a path to get to a point of profitability before running out of cash. But we think we've mitigated that risk sufficiently at this time. So now there's a story to tell about growth and about cash mitigation and financial strength, and giving ourselves that path towards profitability, and actually seeing where that is going to be, knowing what we're doing in terms of stripping costs from the company. And so with that story, that's step one. Now it's about who do you tell it that story to, and in what platforms. And look, we're a penny stock on the Toronto Stock Exchange. So while we want institutional investors to purchase our shares and to drive volume, it's unrealistic for us to believe that any of them are going to come in with any kind of large position at this time. So we have to keep those relationships, hot. So when the time comes, you're not starting that from scratch. They're going to be ready, willing, and able to come in to the story when that time comes. But in the meantime, we have to go to a broader group of potential investors and tell the story as it is. And it's one about value and being undervalued, which we are relative to our peer group. And that's for certain, if you look at the comparatives. And so, it's about how do you reach those investors, and we are going to be getting very aggressive in terms of that kind of outreach, whether it's the investor conferences we go to and how we speak about ourselves, what we're putting into the stratosphere in terms of PR, and then where you might end up seeing us versus just on Instagram or Facebook or Twitter with product and promotion. Maybe you might start seeing us on Yahoo Finance and Seeking Alpha and other areas like Reddit, where we might show up a little more often now. So it's not just about selling people our water; it's about maybe getting them interested in the stock as well and the story. So we are getting aggressive. We have a plan. We're going to put resources behind it because we think it's a great way to unlock value. Somebody says, I believe that water tastes better from carbon format than plastic. Why are there only 2 large product producers of carton format water, and will we see other large entities entering this market? I think, look, this is a new format for consumers to drink water. I think people are used to drinking, juice packs out of a Tetra format, but the Prism, is relatively new. And it's takes a bit, you can't see the water, and there's things that people, traditional things that maybe consumers think of when they think water, but we're breaking those barriers and it's becoming more popular, and you can see it through our growth. And you're right, there aren't a lot of players in it, which helps us because we get more and more market share as there's uptake. And Tetra is a wonderful partner, and they're doing a lot to unlock this format within the water channel. And so, will other competitors come in? Yes, that's the long and short answer. Yes, but the time that it takes to get into this, the barriers are not easy. There's a big barrier to entry. It's capital intensive. This packaging is not the same as a slim aluminum can or a thin plastic bottle with a plastic cap. This is plant-based cap, but completely biodegradable. The packaging's a little more expensive, but it's a premium water, and that tastes like a premium. It's a terrific water, and I think that's what you said, and that's right. We've won a lot of awards for our water, and that's not going to stop. I don't believe it's a great product. So we will inevitably continue to try to gain market share and to proliferate the market with this format. And the sustainability of this format is something that ultimately retailers and consumers both enjoy and find important. And so we've been very lucky to be able to find great partners who want to carry this product and give it some space and listing within their retail environment. So we're going to continue to go down that path and push it hard. I guess I only have a few more minutes. Are you raising prices and have costs been impacted by inflation? Yes. Look, we're not immune to cost inflation. So the price of packaging has gone up, as is labor, as is a lot of things, utilities. And so our cost of production have increased, as most people in CPG have experienced. And so most companies, I should say. And so, yes, we have passed on some pricing increases to the consumer, but we have to remain competitive, And so if we're in a water set in a retail environment, we can't exceed everyone else unless there's a proposition there that the consumer is willing to pay more for. And that does happen sometimes, but we need to be competitive. So we can only push through pricing increases to the degree that that it's sustainable to do so. So we have done a few, but we believe our margins haven't come under the pressure to the way some others have, because of the production capabilities we have, especially at our Aurora plant. Now that we've sold off Verona and we're only paying for what gets produced, so we don't have that capacity underutilization issue anymore. And in Aurora, we've moved a lot of our co-pack that used to be down in the United States up to Canada, which is making that plant even more efficient again. So we have done some things to mitigate those costs being increased on our side. So I think that's all the time I have to answer questions at this time. There's a few more there. I apologize for not getting to them, but I am coming up on time here. I have about 10-15 seconds. So I want to thank everybody again for being here and for hopefully buying and purchasing our water and enjoying it in volume, please sign up for our e-commerce site and have it delivered straight to your home, and check out our shares. It's not a bad buy right now. Thank you, everybody.